Hi, and welcome to my presentation on mutual funds and ETFs, active versus passive management. I'm Ted Carr. Welcome back. If you're new to my YouTube channel, thanks for joining me. I hope you enjoy this presentation. Here's a look at what I'm going to be covering today. I'm going to open up with a few announcements from the shameless self-promotion desk, followed by why this topic interests me and hopefully you too, followed by a brief review of what a mutual fund is and an ETF, followed by really the heart of the matter, which is active management versus passive management, followed by the pros and cons of both ETFs and mutual funds, and then I'll wrap things up. So let's get going. First, if you subscribe to my YouTube channel, thank you very much. I really appreciate it. If you're new, please consider subscribing, and for everyone, feel free to like this video and share your comments. I'm always interested in hearing your thoughts. Next, from our homepage, latertofire.com, you can do a number of things. First, you can subscribe to our free monthly newsletter called The Roundup. And you can download the Later to Fire Quick Start Guide, which lays out 3 simple steps to get people who are interested in pursuing financial independence, retire early, on their way. And you can subscribe, or I should say, start the subscription process to our Later to Fire podcast. Last point is I have a Facebook group that I manage. It's called Retirement Journeys 1, and you're welcome to join. I hope you do. All right, so here are the reasons why this topic appeals to me, and hopefully you too. I ran across some research from Raymond James Financial Services, and what they said was that 17% of investors, not people at large, but investors, don't know the difference between a mutual fund and an ETF. So I thought, that's interesting. And 25% of investors don't have a preference. Now me, full disclosure here, I have a preference. I'm a big fan of ETFs. Now for those who do have a preference, many more favor mutual funds over ETFs. So another reason is mutual funds are popular with employer-sponsored retirement plans. And maybe that helps explain the previous point. ETFs haven't found a way to break into the world of 401ks, 403bs, and Roth IRAs. Those are pretty well dominated by mutual funds, typically provided by some financial services company. Another really interesting point or important point to note is that if you decide at some point that you leave your job, you've got money in your 401k, do you roll it over or leave it where it is? So if you don't really understand the difference between an ETF and a mutual fund, you may say, what's the difference? I'll just leave it where it is. But if you have a better idea of the difference between the two, you might have a different thought process in terms of whether you roll it over or leave it where it is. And lastly, it's really important to understand the structures of ETFs and mutual funds as they pertain to fees and taxes, because the additional fees and taxes can significantly affect your long-term investment returns. And that's really where we're coming from in this presentation, is looking at long-term investments. All right, so that's why I chose the topic. So let's briefly review what an exchange-traded fund is and a mutual fund. So an ETF is a collection of securities that trade on an exchange, much the same way that an individual stock trades. Many track an index replicating a particular market, sector, or commodity. There's almost an ETF for everything you can think of. Indices are weighted by price, market cap, or equal weighting. They feature low expensive in fees, and they're passively managed. And what's really great about ETFs, I think, is that you control when you get a capital gain or when you take a loss. It's when you decide to buy or sell. Now, mutual funds, these are investment portfolios of stocks, bonds, and other securities. And they're categorized by the kinds of securities they invest in and their investment objectives, such as, value portfolio or large cap or growth. So those are sort of the objectives that a mutual fund manager would have in their mutual fund. Now, mutual funds are bought and sold at the end of the trading day. That's when the net asset value, the NAV, is calculated. That's what you sell at. That's what you buy at, regardless of what point during the day you decide to make that transaction. Now, what you own in a mutual fund is not the underlying security, but you own a share of the portfolio. And as I mentioned earlier, higher expense ratios. And expense ratio simply means the share of your assets, the amount you have invested, that the fund takes each year as compensation for managing your money. All right, so let's take a little bit deeper dive into active versus passive management, because I think, again, this is the underlying matter when it comes to ETFs and mutual funds, maybe the biggest differentiator. So active management means they focus on outperforming a specific benchmark, such as the S&P 500 index or the Dow 30. Every mutual fund has its own benchmark. So think of the number of benchmarks that are out there. And that's what the manager is trying to do, is beat that benchmark that is tied to their mutual fund. As you would well imagine, they are more resource intensive. You have to have analysts, managers, a lot of administrative people that are handling all the things that go on in a mutual fund. And again, the premise behind active management is that professional management can beat their benchmark by knowing when to buy, when to sell, and how much. And that term is referred to as alpha. And you can find alpha on finance.yahoo.com when you do a search for a mutual fund. If you see an alpha that says 2, that means it's going to give you 2% greater return than the benchmark. So just worded wise, alpha measurements can be a little bit subjective, so I wouldn't put too much stock in them, but it is something that exists and that people do look at. Now, passive management, on the other hand, mirrors the investment holdings of an index to achieve similar results. Not identical, but similar. Holdings are changed when the index changes, sometimes quarterly. And all the person's doing that is managing that ETF is, S&P 500 is going to drop this stock and add this stock. So all they have to do is get rid of that stock and mirror the other one. So it's not a lot of analysis that goes on. And really what's behind a passive management, people like me who have a preference for passive management, is something called efficient market hypothesis or theory. And what that says is that everything that is to be known about a stock is baked into that price at this point in time, that there is no extra knowledge out there that's waiting to be discovered, that an active management person would say, yeah, that's how we're going to get alpha. We're going to figure that out, and we're going to take advantage of that and provide better returns. Now, there are, of course, a lot of variation within that matter, and there are people like Warren Buffett who do beat their benchmarks and do provide alpha. But in general, overall, long term, I think the passive management, the data and the studies have proven that it's very effective relative to active management. In fact, next we're going to take a look at a few scorecards. So these scorecards come from a group called SPIVA, Standard & Poor's Indices versus Active. And SPIVA is a division of S&P Global, which is a company that provides a ton of market data and market intelligence. So I'm not going to go through each one of these pie charts, mercifully, but I'll just point out here that these pie charts each represent a type of U.S. equity. And you see like domestic funds, real estate, large cap, and the blue are the number or the percentage of mutual funds that did better than the benchmark. So you can pause it and look at each one that interests you, but you can see right away that most of the time, and this is a 15-year analysis, I believe, it's really hard long-term for underlying mutual funds to beat their underlying benchmarks. Next, these are international equity funds and benchmarks. And the same holds true here, that it's really hard to beat it. Some do, but in general, they don't. And the last one are fixed income. And they switch from blue to green. I don't know why, but you can see again that the benchmarks do better than the actively managed funds. Pros and cons of ETFs. Again, they trade like stocks where you can have a stop limit order. You can buy in at a limit order. You can invest in sectors and niches. There are tons of ETFs. which gives you a lot of flexibility. If you want to underweight or overweight things, you can do that with ETFs. They feature low fees, tax efficiency. You control the gains and the losses when you want. They're great for buy and hold strategies, long-term investing. And if you don't want to do a lot of research into mutual funds, because again, you're looking at a strategy, they're great for people who don't have the time or inclination to do all the research into a mutual fund. And the cons, kind of esoteric. Tracking errors, meaning that they can't identically replicate or mirror an index. And low volume ETFs may have a higher bid-ask spread. And that's true, I think, of any low volume traded stock or security. Is if there's not a lot of volume, those spreads are going to be larger. Taking a look at mutual funds, professional management, alpha. So a lot of people do think that there's a lot to be gained by having someone professionally manage their investments for them. And there are many funds that match investment styles and their objectives. And in general, they're pretty easy to understand. And then on the con side is it's very difficult to consistently outperform their underlying benchmarks, which throws into question the whole active versus passive management premium that mutual funds ask and have you pay. Higher fees, less tax efficient, and that's something that's burned me in the past where I'm getting toward the end of the year, getting the taxes together, and boom, out of the blue comes some distribution from a mutual fund and just messes up your taxes. So that's one of the reasons that I favor ETFs, is I control the timing of gains or losses. And some may require a minimum investment amount where you have to put in a minimum of $2,500, or subsequent amounts you invest have to be $1,000 or whatever. So I guess it's just more restrictive in some ways than ETFs. Okay, let's summarize what we've covered today. So one of the neat things about ETFs, because their fees are lower than mutual funds, is I've seen a chart where over time the price of mutual funds, the fees are going down because they're competing for your dollars. ETF funds are competing with mutual funds. And guess what? ETFs are cannibalizing companies' revenue. And so, golly, the way they respond to stay in the game, mutual funds I'm speaking of, is they have to lower their fees too to be competitive. So that's a good thing with ETFs. Now, as I've shown hopefully in this presentation, passive management, i.e. ETFs, have more advantages than active funds. And for long-term investors, I think you're going to get a better return on your investment if you can incorporate some ETFs into your portfolio. And as I've alluded to, you really have to understand mutual funds because it's almost inescapable that you're going to have some mutual funds. Like for me, I own a mutual fund for Arizona municipal bonds because there's no ETF. I can't find an ETF for Arizona muni bonds, so I go with a mutual fund, and it's got a low fee. It does okay. It meets my needs. As I said earlier, employer-sponsored plans don't have ETFs. So when you're looking at what's available in your 401k or 403b or whatever the case may be, you look for low-cost index funds, and a lot of people are into target date funds. Now, just a word of caution, when it comes to a target date fund, just pick one. Put everything in that. If you start putting money across target date funds, you start working across purposes and duplicating things, and I don't think that's the best way to use a target date fund. Now, another interesting phenomenon that's occurring, and I call it beware the rise of actively managed ETFs. So a lot of companies, I mean a lot, are looking at their underlying ETF, and then they're adding some active management component to it. And guess what? They are charging more for that additional layer of stocks or other securities that they add to that ETF. And they have different names for these actively managed ETFs. To me, it's kind of an oxymoron that they would even say that. But it's just something to be aware of, and you're going to be paying more for an actively managed ETF, and you lose one of the things called transparency. ETFs, you can go to any ETF and you can see everything that's in that ETF. You can't do it in a mutual fund. You may get the report once a quarter and you'll see everything that was in it, but that's history. An ETF, you can see what's in it today. When it comes to an actively managed ETF, they're going to call them semi-transparent. So if that's important to you to really know what you're investing in at this point in time, at the moment, then an actively managed ETF is going to be a little bit more like, it's got kind of a hybrid cross between a mutual fund and an ETF. The real reason they're existing is to give people jobs so they can charge you more money. Disclaimer, I'm not a financial professional, though I love finance, as you know. I'm not making any recommendations, endorsements, offering advice. What I present here is just hopefully illustrative, informative, interesting. When it comes to making your financial decisions, please seek your own professional financial counsel. Your investments decisions are yours to make. Lastly, I want to say thank you for the privilege of your time. And I hope you enjoyed this presentation. I don't know what I'm going to do next, but stay tuned for another presentation that'll be coming shortly. And at this point in time, I just want to wish you all the best. Stay safe, stay well, take care.